Today we will talk about what you should invest to outperform fund managers. Financial future of any one corporation is unpredictable, and the price of its stock is even less predictable because it depends on many factors. Later I will go into the reason investing in one or several stocks is risky. A better strategy is investing in hundreds and thousands of corporations simultaneously by purchasing shares of a stock index fund. Investing all your savings in one or several stocks is a bad idea because there are too many variables that the investor cannot predict. For instance, Number 1. Future changes in the management of the company. Number 2. Accidents. Number 3. Natural disasters, as some companies are closely tied to the changes of environment. Number 4. Political changes. Number 5. Future changes in the marketplace such as new technologies, consumer preferences, new competitors. Changes in investor preferences affect stock price. Investing in one or several stocks is similar to gambling because luck plays a major role in the successful outcome of this activity. It is understandable that these investors are trying to outperform the market average return on investment of about 10% per year. Yet it is highly unlikely that they will pick a winning stock and keep holding and buying it as their sole investment for decades. Past performance of a stock is not a guarantee of future results. They are trying to win a lottery, but instead, there is a high probability that this investing strategy will perform worse than the market average in the long run. There is also a small risk that the company in question will go bankrupt. A number of studies have shown that the absolute majority of fund managers, who are not amateurs, by the way, cannot outperform the market average in the long run. That is, they cannot provide their clients with a long-term return on investment better than 10% per year. For example, a recent research article showed that only about 0.6% of mutual fund managers can grow your money faster than the market average. The article examined a period of 30 years and it took into account fees and expenses. People who are not professional investors are even less likely to pick a stock or a portfolio that will outperform the 10% per year. If the great majority of professional investors cannot outperform a broad stock index, then it makes sense to invest in the broad stock index. Some might wonder, what is a stock index? It is a fund that holds hundreds of different stocks and to hold it for decades. It also makes sense to avoid picking and choosing stocks and actively managing the portfolio. Thus, diversification, or simultaneous investing in a large number of stocks, is key to successful and safe investing. Warren Buffett, arguably the best investor in the world, holds a well-diversified portfolio of stocks. A recent study showed that his portfolio had outperformed the average by about 14% per year, based on data from 1976 to 2006. Nonetheless, if copying Warren Buffett's investing approach were easy, then there would be a far higher percentage of fund managers who outperform the stock market average. The notion that it is easy to outperform the average market return is self-contradictory and fallacious at its core. The majority of people cannot be better than average in principle because the average reflects performance of the majority of people. Although Warren Buffett has often revealed his basic investing principles, the devil is in the details. It is also possible that he has some special talents that 99.4% of fund managers do not have. I am not a certified financial advisor, but you can do what Warren Buffett says unskilled investors can do. That is to put your money in an index fund and hold it there forever. This is the precise, by periodically investing in an index fund, for example, the know-nothing investor can actually outperform most investment professionals. Paradoxically, when dumb money acknowledges its limitations, it ceases to be dumb. This investing approach is going to be successful if you are patient and going to hold this investment for decades, ignoring year-to-year fluctuations of the value of your portfolio. Don't check on your portfolio every month or even every year. You shouldn't be afraid of a stock market crash because it will let you buy the same index at a cheaper price. This principle implies that you are going to save and invest about the same amount of money each year. After several decades, your gains are likely to exceed your temporary losses with a vengeance. You can ignore financial advisors, hedge funds, and all financial literature and financial TV programs. The probability that you will find an outstanding fund manager and stay with him or her in the long run is negligible. If you decide to invest in Warren Buffett's company today, you shouldn't expect it to grow at the same rate as it did in the past 40 years. Today, Berkshire Hathaway is too large and therefore unlikely to deliver a higher than average return on investment. When stock indexes do go up, they do not go up in a straight line, and there are substantial year-to-year. Before going on, if you feel that I have given you some value, please help me by smashing the like button, subscribe to my channel and turn on the notification bell, so you will be updated when I upload new videos like this. If you are uncomfortable with the fluctuations of stock prices, you can invest in government bonds, such as federal, state, or municipal bonds. State and municipal bonds yield higher income than federal bonds in the United States if you take into account their tax-exempt status. In case you are wondering, what is government bond? And how do government bonds work? Government bond are bonds that government give out to the people to invest. For example, if the government needs money to build a new subway, they will come up with bond for people to invest so they have money to build a new subway. So when you buy a government bond, you lend the government an agreed amount of money for an agreed period of time. In return, the government will pay you back a set level of interest at regular periods, known as the coupon. Interest income on federal bonds is not tax exempt, whereas that on state and municipal bonds is tax exempt, with rare exceptions. Research shows that investment in broad stock indexes has outperformed investment in government bonds in the United States during the last half a century. It is likely that this trend will hold true for the next half a century, although these things are difficult to predict with certainty. The example of the Japanese stock market, Nikkei 225, suggests that in rare situations, bonds can outperform stocks over a period of 2 or 3 decades. A small return on investment is better than a zero or negative return. To safeguard against extended periods of bad performance of a stock index, you can invest in stock indexes of many countries simultaneously. This global diversification will not eliminate year-to-year fluctuations, but is likely to minimize the risk of negative returns over a period of several decades. Examples like what happened to the Nikkei 225 index. There are no investment opportunities out there that guarantee huge returns with low risk. In rare situations when such opportunities do arise, the discoverer exploits them to the fullest and does not advertise them in books or on TV. If someone's purpose of investing is to get rich, this means that this person is relying on luck. For example, he wants to invest in a single stock, a single startup company, or a bunch of lottery tickets. This person will most likely sustain losses. Well, some might say it is a calculated risk. This is true, you can do all your homework on a company and reduce the risk of losing money. But it does not eliminate it. On the other hand, there are at least 3 types of smart investments that do not require luck. They are: Number 1. A down payment on a mortgage, or if you already have a mortgage, paying off the mortgage faster than necessary. Number 2. Government bonds or bank deposits. And number 3. A stock index fund. These approaches can increase your net worth over decades with low risk. We already discussed government bonds and index funds and will now talk about investing in your own housing. Although a mortgage loan can be considered a liability, you owe a lot of money to the bank. An asset, your house or apartment, will offset this liability. This arrangement gradually increases your net worth because it allows you to build your home equity, which is the market price of your housing minus what you owe to the bank. Mortgage rates are comparable to inflation rates in many countries. If your salary increases at the same rate as inflation or faster because of promotions or raises, then you may consider your mortgage an interest-free loan. Thus, investing in the housing that you can afford is a good investment strategy. The key phrase here is housing that you can afford, meaning that you should be able to easily make the monthly mortgage payments at your level of income. If the sum of your monthly debt payments, including mortgage, constitutes about 25% of your gross monthly income, before taxes and contributions, this is an affordable mortgage loan. There is one exception: when renting is better than having a mortgage. If you are trying to start a business or if you just started a business, renting will be less stressful, as getting a mortgage will be a bad idea. If you have plenty of money to invest, then buying real estate and renting it out will be a good low-risk business. On the other hand, if you have high income and want to save money for a different kind of business, that is unrelated to real estate, then you should not put your money in real estate and instead save it in bank deposits, protected by government insurance. First, you will not lose money on commissions of realtors when buying and then when selling real estate. Second, you won't have to spend your time on real estate business and will be able to concentrate on your main job. Third, you will not lose money because of possible fluctuations of real estate prices. And do remember not to fall for the give me a little money and I will show you how get rich scam, which is one of the oldest fraudulent schemes in the history of mankind. Numerous authors have repackaged this scam in a multitude of formats: late-night TV infomercials, books, website subscriptions, videos, software, Facebook ads, seminars, and so on. and sold it to tens of millions of people. Think about it. Suppose someone knows how to make $1 million easily with 100% guarantee and is willing to give you this information for a small fee, say $300. This transaction is equivalent to their giving you $1 million out of their own pocket in exchange for $300. This is an illogical and unfair exchange for the seller of easy wealth. Unless the seller is a charlatan and selling useless, untested, or false information. No wonder the advice in how to get rich books is almost always vague, lacking details, and heavy on motivation or popular psychology instead of practical steps. If there were a concrete and reliable step-by-step approach to making a fortune, then the first person who learned about this method would milk it dry. This person would try to leave nothing to everybody else. Hope that all these tips on investment helps you in your journey. If you like my video, please hit the like button, subscribe to my channel and comment down below. Thank you.